Chapter 9, Business Valuation. When we're dealing with businesses in the state of Florida, what we're talking about is dealing with going concern operations. That is an up and running business. In the state of Florida, anybody who sells a business needs to have a real estate license. The reason for that is that real estate is going to be transferring some way. Whether it's going to be in the sale of a building or whether it's going to be in the transfer of a lease, real property will be transferring. When we're evaluating a business, we need to understand the various types of businesses that we're dealing with, whether it's a sole proprietorship, partnership, or a corporation. And once we have made that determination, because if we're dealing with a corporation, it may be stock that we're evaluating rather than anything else. One of the things about a business broker and about the way that they do business is that they have to understand financial statements that regular real estate brokers don't have to understand. A balance sheet and an income statement are going to be two important things. For instance, a balance sheet is simply a snapshot of a business as of a given date. An income statement might be your profit and loss statement that might be shown over time. We call that a horizontal analysis. The inventory costing method is a way that a lot of business brokers come in and evaluate a business, and it has to do with first in, first out type of process. We call that FIFO and LIFO. A good way to remember this is that FIFO is fat, LIFO is lean. And all we're talking about is the inventory. If it's the first in, it needs to be the first out because the cost up front is probably going to be less than the cost later. Analyzing financial statements. There are a couple of financial statements that we need to be able to analyze. First of all, a quick ratio. A quick ratio is simply your current assets minus inventory divided by your current liabilities, whereas the current ratio is your current assets divided by your current liabilities. We call that the asset test. There's also the inventory turnover ratio, which is the cost of goods sold divided by the inventory turnover, or the ending inventory. The valuation methods to a business. We're going to be looking at a business in 4 ways instead of 3. First, we're going to be doing the comparable sales approach. Second, we'll be doing the cost appreciation approach. And third, we'll be doing the income approach. But what is unique to business that we don't do in real estate is something called the liquidation value approach. The liquidation value approach is simply taking assets, selling them off, paying off all of your liabilities, and whatever's left over is going to be minimum value of that business. Also, what business brokers need to understand over, regular real estate brokers is understanding assets, whether they're tangible or intangible, especially those intangible assets. An intangible asset is something that you can't get your hands on. A tangible asset is one that you can. When we talk about intangibles, we talk about business goodwill, we talk about personal goodwill, and we talk about separable intangible assets, such as franchises. When a business broker is appraising a business, we have to consider all of these. Sometimes what they're going to use is something called the excess profit approach. And all the excess profit approach is going to take a pro forma net sheet and take a look at the incomes and subtract out all those things that are there because of the tangible assets. Whatever's left over should be your intangible assets. And that is the end of Chapter 9. What I'd like to do right now is go over those important parts of Chapter 9 that you may see again. Evaluating an up and running business is determining going concern value. The 3 major types of business entities are sole proprietorship, partnership, and corporation. A balance sheet is a snapshot of the business as of a given date. In other words, it's your assets, which equal your liabilities, plus any owner's equity. An income statement is an analysis of income and expenses over time, typically called our horizontal analysis. Cash-based accounting is income in, expenses paid in the year earned and spent. Accrual-based accounting allows large debt to be spread over a period of time. The current ratio is your current assets divided by your current liabilities. The quick ratio is current assets minus any inventory divided by your current liabilities. Intangible assets include business goodwill, personal goodwill, and separable intangible assets such as franchises. The excess profit approach compares the pro forma net profits to tangible assets. Liquidation value approach is unique to business appraising. And that's the end of our Chapter 9 summary.